Trevor, we last had a chance to talk in April, and it seems like a good amount has changed since then. There are now, one new round of tariffs from the president and a threat for another round of tariffs since the president. And the market now is in a sort of almost extreme mode of forecasting coming rate cuts. What's your view? How do you process these tariff announcements from the president of the United States?
Well, I think we have to be careful in looking at where the economy is and where we think it's going. So it's only been 6 weeks since we talked last time, Steve, and I think the fundamentals for the economy continue to be solid. I think the consumer continues to be in a good position. Labor markets continue to be strong. Business fixed investment is probably not quite as strong as I would like, and there's probably uncertainty that's impacting that, and some of what you're talking about in terms of trade uncertainties, the global environment, how Europe and China and emerging market economies are growing or how they might be slowing down is an issue. And so I think we have to think about that. We've indicated we're data dependent. I'm a little nervous that inflation is underrunning our 2% objective. I said that 6 weeks ago. And, I think that there is a reason to be thinking about the stance of policy. I'm pretty comfortable with where we are at the moment and looking at the data, but there is uncertainty for sure.
So a policymaker who's a little nervous might not do anything, but a policymaker who's very nervous about low inflation might cut rates. Are you towards that idea of cutting rates in response to low inflation?
It's a great question, and I think it sort of gets at the committee's perspective and how we react to the data. I frankly would be a little more aggressive than most in terms of defending our 2% symmetric inflation objective. I think that one of the messages in some of the papers that we're going to hear about today and tomorrow is, what does it mean to hit your inflation objective? Are there other means, price level targeting, temporary price level targeting, over the economic cycle to hit 2% symmetrically? And if you're going to underrun at the beginning, maybe you should overrun that to 2.5% after that. And so myself, I could definitely see being more aggressive, but that's sort of a strategic reaction function question.
I get that, and compartmentalize, that makes perfect sense. But now overlay the possibility of not only the existing tariff regime with China, but additional tariffs on top of that, and a possibility of tariffs with Mexico. Tariffs, at least in the first order, raise prices. How does the Federal Reserve cut interest rates in the face of higher tariffs that raise prices?
Well, for one thing, we're underrunning our inflation objective at the moment. I mean, it's 1.6% year over year on the core. We've talked about how it's likely temporary, but I also think that we should be overshooting 2% in order to be symmetric. So I think the magnitudes of the one-off price increases that you would expect to see from a tariff increase are easily manageable, and we can look through that. The concern would be if you saw very strong increases in prices that somehow were accommodated by monetary policy that led to inflation, upwards of 2.5% or more. I don't see anything like that. I mean, we're so far from that. Even with a very low unemployment rate at 3.6%, the economy is performing better and differently than it has in the past. The inflationary pressures seem to be not strong or perhaps absent. And so I think some light tilt to accommodation on monetary policy is okay. We're at the low end of what most people think of as neutral. And so given the economic situation, I think that's appropriate. I do think that, we don't want to get in the way of the economy. And the economy has been strong. And I think that our current setting has been appropriate. But if we sense that there was some greater uncertainty, some softening, we'd have to take that into account and ask, are we getting in the way of the economy? I don't see it that way at the moment, but we need to be looking at the data.